Question 481. The purchase of a single-family residence can result in the following income tax deductions, except A. Painting the house. B. Loan points. C. Loan interest payments. D. Property taxes. Correct answer is A. Painting the house. Loan points are fees paid directly to the lender at closing in exchange for a reduced interest rate. They can usually be deducted in the year they are paid, for the purchase of a primary residence. Homeowners can typically deduct the interest paid on their mortgage, up to certain loan limits. The real estate taxes paid to state and local governments are generally deductible, subject to certain limitations. Therefore, the exception is painting the house. Question 482. As a real estate term, setback refers to the A. Loss of a commission to a broker when a real estate transaction fails to close. B. Distance from a curb, property line, or structure within which building is prohibited. C. Distance between the front of a property and the street. D. None of the above. Correct answer is B. Distance from a curb, property line, or structure within which building is prohibited. Loss of a commission is referred to as a failed closing, not a setback. While the distance between the front of a property and the street is indeed a type of setback, the term setback is broader. It refers to the legally required minimum distance between any structure and all property lines, including front, side, and rear boundaries, not solely the distance from the street. Therefore, a front yard is a specific example of a setback. In real estate and land use, a setback is the legally required minimum distance that a building or structure must be separated from property lines, streets, or other structures. These regulations are typically established by local zoning ordinances to ensure adequate light, air, open space, and safety. Setbacks can apply to the front, side, and rear of a property. Question 483. Which of the following is not necessary to create a binding contract? A. Offer. B. Acceptance. C. Recording. D. Consideration. Correct answer is C. Recording. To create a binding contract, the following elements are generally necessary. A. Offer. A clear and definite proposal made by one party, the offerer, to another, the offeree. B. Acceptance. Unequivocal agreement to the terms of the offer by the offeree. This acceptance must be communicated to the offerer. D. Consideration. Something of value exchanged between the parties. This can be a promise, an act, or forbearance, and it must be legally sufficient and bargained for. 4. Legal capacity. The parties entering into the contract must have the legal capacity to do so, e.g., they must be of legal age, of sound mind, and not under duress. 5. Legal purpose. The object and purpose of the contract must be legal and not against public policy. Therefore, offer, acceptance, and consideration are fundamental requirements for the formation of a binding contract. Legal capacity and legal purpose are also essential for the contract to be valid and enforceable. Recording is the act of publicly registering a document, such as a deed or mortgage, with the county recorder's office. Recording provides public notice and establishes priority but isn't required for a contract to be legally binding between the involved parties. An unrecorded valid contract is still enforceable between the buyer and seller. Recording primarily serves to protect the interests of the parties against claims from third parties. Question 484. Paul and Arthur want to open a music store. Their friend Bob promises that if Paul and Arthur start a store, he will sell them all of the guitars they need for $50 per instrument for their first year in business. However, when they open the store 3 years later, Bob says higher demand has necessarily increased his price to $100 a guitar. If Paul and Arthur sue Bob for breach of contract, they will likely A. Win, because they cannot procure guitars anywhere else for $50 apiece. B. Lose, because such a low price for a guitar is unreasonable. C. Win, because the condition that Bob based his promise on was satisfied. D. Lose, since 3 years have elapsed since Bob made his promise. Correct answer is C. Win, because the condition that Bob based his promise on was satisfied. A condition precedent is a condition that must be met before the performing party has a duty to perform. Once the condition is met, performance is required. Here, the condition precedent for Bob's promise was for Paul and Arthur to open a music store. Once they did that, Bob's duty to sell them guitars at the price he originally quoted was triggered, and he is contractually bound to do so. Question 485. Cammie the owner sells her home to Fred the buyer for $300,000 while agreeing to finance a loan for Fred. This transaction is known as a unconventional loan, B. reverse mortgage, C. land contract, D. HARP loan. Correct answer is C. land contract. While owner financing might deviate from typical institutional lending, unconventional loan isn't a specific legal term for this type of transaction. It's a broad term that could encompass various non-standard financing methods. A reverse mortgage is specifically designed for homeowners aged 62 and older to access their home equity without making loan payments. It's not applicable to a sale between a buyer and seller where the seller finances the purchase. The Home Affordable Refinance Program, HARP, was a federal program that helped homeowners refinance their mortgages into more affordable options. HARP was intended for borrowers who might not otherwise qualify for refinancing due to factors like declining home values or limited access to mortgage insurance. Borrowers with little or no equity in their homes, or who were underwater on their loans, were encouraged to apply. HARP allowed borrowers to make changes to their mortgages, such as lowering interest rates, shortening loan terms, and changing from an adjustable rate mortgage to a fixed rate mortgage. In a land contract, also known as a contract for deed, land installment contract, or an installment sale agreement, the seller provides financing for the buyer to purchase the property, which the buyer repays in installments. Under this kind of contract, the seller, Cammie, acts as the lender and retains legal title to the property until the buyer, Fred, has made all the payments according to the agreed-upon terms. Fred takes possession of the property and makes payments to Cammie over time. Only after the final payment is made does Cammie transfer the legal title to Fred. Question 486. Joni owns and runs a small clothing store. After a client sustains serious injuries when she slips and falls on a wet floor in the store, the client sues Joni and the store and wins a judgment in court. The client will likely be able to collect on the judgment. A. Against Joni and the store, B. Against just Joni, C. Against just the store, D. Against the city for failing to properly regulate Joni's property. Correct answer is A. Against Joni and the store. Based on the description, Joni owns and runs a small clothing store. It's highly likely that the store is a sole proprietorship. In a sole proprietorship, there is no legal distinction between the owner, Joni, and the business. They are considered the same legal entity. This lack of legal separation means that Joni is personally liable for the debts and obligations of her business, including legal judgments. The client sued Joni and the store, and won a judgment against both. This explicitly makes both Joni, as an individual, and her business liable for the amount of the judgment. The client can then pursue collection efforts against both the assets of the business, e.g., store inventory, bank accounts held in the store's name, and Joni's personal assets, e.g., personal bank accounts, other property she owns. The city's role in regulation does not typically extend to bearing financial responsibility for injuries sustained on private property due to the owner's negligence, in this case, the wet floor. The liability lies with the property owner and operator. Question 487. In signing an agency listing with a particular agency, the owner agrees to the following. A. Pay a commission to the agency if the agency sells the listed property. B. Pay a commission to the agency even if the owner sells the listed property himself. C. Pay a commission to the agency even if a different agency sells the listed property. D. Both A and C. Correct answer is D. Both A and C. When an owner signs an exclusive right to sell listing agreement with a real estate agency, they enter into a binding contract with that specific brokerage. A key element of this agreement is the owner's commitment to pay a commission to the listing agency under specific circumstances. A. Primarily, the owner agrees to compensate the agency if the agency itself successfully procures a ready, willing, and able buyer for the property at the agreed-upon terms or at a price acceptable to the seller. This incentivizes the listing agency to actively market the property and work diligently to find a suitable buyer. However, the exclusivity of this type of listing extends beyond just the listing agency's own efforts. The owner also agrees to pay the stipulated commission to the listing agency even if the property is sold through the efforts of a different real estate agency during the listing period. C. This recognizes the listing agency's sole right to market the property and ensures they are compensated for their time and resources invested, regardless of which agent ultimately brings the buyer. This provision is a defining characteristic of the exclusive right to sell agreement, providing the listing agency with the maximum protection for their commission. Under an agency listing, the seller has the right to sell the property himself without paying any commission. Question 488. Most lenders apply the C's test to screen loan applicants, which include A. Character, B. Capacity, C. Collateral, D. All of the above. Correct answer is D. All of the above. Character refers to the borrower's honesty, reliability, and credit history. Lenders want to know if the borrower has a history of repaying debts on time and responsibly. Capacity assesses the borrower's ability to repay the loan. This includes factors like income, employment stability, and debt-to-income ratio. Lenders want to ensure the borrower has sufficient income to comfortably cover the loan payment along with their other financial obligations. Collateral refers to assets pledged as security for the loan. If the borrower defaults on the loan, the lender can seize and sell the collateral to recoup their losses. Not all loans require collateral, but it can be a factor for some loans, like mortgages or auto loans. If one of the components is not at an acceptable limit or if there is excessive layering of risk across these components, the mortgage will likely go unapproved. Question 489. The phrase, "It goes with the land," most aptly describes A. Appurtenant easement, B. License, C. Homestead right, D. Contract. Correct answer is A. Appurtenant easement. An appurtenant easement burdens one piece of property for the benefit on another. Such as a driveway to the street for Lot A, dominant tenement, that crosses over Lot B, servient tenement. This type of easement runs with the land, i.e., if either the dominant tenement or servient tenement has a transfer in ownership, the new owner receives the benefit, or takes on the obligation, of the easement. Question 490. A franchise agreement establishes an agency, by which the franchisee is the agent of the franchisor. B. Employment arrangement, by which a franchisor treats a franchisee as an independent contractor. C. Legal right to operate a business under a common name and marketing plan. D. Both A and C. Correct answer is C. Legal right to operate a business under a common name and marketing plan. Although a franchisee operates under the franchisor's brand, a typical franchise agreement generally does not create a true legal agency relationship. In most cases, the franchisee lacks the authority to contractually bind the franchisor. A franchise agreement explicitly establishes the franchisee as an independent business owner, not an employee or an independent contractor for the franchisor in an employment sense. The franchisee owns and operates their own business using the franchisor's system. Therefore, the core of a franchise agreement is the granting of a license or right to use the franchisor's brand, operational systems, and marketing strategies in exchange for fees and adherence to certain standards. There is no employment relationship, and while there's a brand representation, it doesn't typically equate to a formal legal agency where the franchisee can act on behalf of the franchisor in a broad contractual sense.